JPMorgan Chase moves more money in a day than most countries earn in a year.
So he had a very unique role, and he had played a leading role in saving the country and the financial system. It was the influence that he had on Wall Street and among banks had the respect, and he had the insight and the ability to act quickly, such that he could corral leaders, heads of banks, heads of trust companies, to effectively impose.
In 1907, the United States financial system was collapsing. Banks were failing, panic spread across Wall Street. There was no Federal Reserve, no bailout, no one in charge, until one man stepped in. He didn't hold public office, he wasn't elected, but when he spoke, America's most powerful bankers obeyed. His name was JPMorgan. And for a moment in history, he controlled Wall Street. Morgan's rise to power did not happen overnight. He was born on April 17, 1837 in Hartford, Connecticut, into a wealthy and influential family. His father, Junius Spencer Morgan, was a prominent banker, a partner at George Peabody & Co., which later became J.S. Morgan & Co. in London. From an early age, Morgan was trained to understand finance. He attended the English High School of Hartford and traveled to Europe to study business and banking in Germany, gaining first-hand exposure to European credit systems and international finance. In 1857, at just 20 years old, Morgan joined Peabody & Co. in London, working closely with senior bankers and learning the complexities of international finance. By 1860, he returned to the United States and joined Drexel, Morgan & Co., the American branch of Anthony Drexel's banking house.
After early defeat, America's back in the fight in North Africa, and they've got the Nazis on the run.
Most heartening of all is the news from Egypt and North Africa.
Some of the Nazis, beaten off in their first real battle with American troops, surrendered.
During the Civil War, Morgan helped reorganize and sell government bonds to finance the Union, contributing to the stabilization of federal finances during a critical period in American history. In 1871, Morgan partnered formally with Anthony Drexel in New York, forming Drexel, Morgan & Co. Here, he began consolidating smaller failing companies, particularly railroads, into profitable ventures. These early deals demonstrated his ability to quietly wield influence and reshape industry without attracting public attention. Morgan's strength was his calm authority. He negotiated behind the scenes, relying on his reputation and credibility rather than public display. By the 1880s, he had become one of the most trusted and influential bankers in the United States, a man whose judgment was sought by both corporations and government. By this point, John Pierpont Morgan was no longer just a banker. He was becoming a central figure in the U.S. financial system, setting the stage to control industries, stabilize crises, and ultimately wield power over Wall Street itself. Railroads and the rise of financial power. By the 1880s, John Pierpont Morgan had established himself as a trusted banker in New York. But the real power lay not in banks alone. It lay in the railroads, the arteries of the nation. Control the railroads, and you control the flow of commerce. At the time, the American railroad system was chaotic. Hundreds of small lines, many bankrupt or mismanaged, crisscrossed the country. Competition was fierce, and rate wars threatened the profitability of even the strongest lines. Morgan saw opportunity where others saw chaos. He began consolidating failing railroads into stable, profitable enterprises. One of his earliest major projects was the Chicago, Burlington, and Quincy Railroad. Morgan helped reorganize its debt, streamline operations, and stabilize its finances. The railroad went from near bankruptcy to a solid, profitable company. He also played a crucial role in the New York Central Railroad, negotiating mergers and preventing destructive competition. Through these deals, Morgan demonstrated a key skill. He did not need to own companies outright to control them. He controlled them through boards of directors, credit arrangements, and strategic alliances. Morgan's influence extended beyond railroads. By the 1890s, he was consolidating major industries: steel, electricity, and shipping. In steel, he orchestrated the merger of Andrew Carnegie's steel holdings into U.S. Steel, creating the world's first billion-dollar corporation. In electricity, Morgan helped reorganize Thomas Edison's and George Westinghouse's companies, stabilizing the emerging industry. His financial support and negotiation skills ensured that these industries could grow without collapsing under mismanagement or competition. But Morgan's power was not just in money, it was in organization. He formed banking syndicates, groups of banks working together to fund massive projects. One of the most famous examples came in 1895 when the U.S. Treasury was running low on gold. Morgan organized a syndicate of banks that supplied $65 million in gold to the Treasury, preventing a potential financial disaster. This act placed Morgan in a unique position. The government relied on him. Corporations relied on him. Wall Street, in many ways, obeyed him. His method was subtle. He rarely sought public credit. He rarely made headlines. Instead, he relied on calm authority, reputation, and the quiet power of money to bend industries and markets to his vision. By the end of the 1890s, JPMorgan had transformed from a powerful banker into an indispensable figure in American finance. Railroads, steel, electricity, entire sectors now moved at the rhythm of his decisions. The stage was set for the crises that would define him as the man who could truly control Wall Street.
The first year in business was absolutely astonishing. They handled more than $1 billion in underwriting and captured 1/4 of the business on Wall Street.
Panic of 1893 and financial dominance. By the early 1890s, the United States was experiencing rapid industrial growth, but the expansion was uneven. Railroads had overbuilt, industries were over-leveraged, and banks were overextended. In 1893, a financial panic struck the nation. Hundreds of banks failed, railroad companies went bankrupt, investors lost fortunes. Amid the chaos, JPMorgan emerged as a stabilizing force. He worked quietly behind the scenes, negotiating with bank directors, railroad executives, and government officials. Morgan coordinated large-scale refinancing for failing companies, preventing total collapse. He also facilitated mergers in the steel and electrical industries, ensuring that failing companies were absorbed into stronger entities. Through these actions, Morgan demonstrated a crucial fact. In times of crisis, American industry and finance depended on him. His reputation for calm authority allowed him to act decisively, without needing public approval. Even presidents and cabinet officials turned to him for advice on stabilizing the economy. By the mid-1890s, Morgan's influence extended beyond individual companies. Entire sectors, including railroads, steel, and electricity, now relied on his guidance and capital. Through strategic lending, corporate consolidation, and private negotiation, he had quietly transformed into the most powerful financier in the nation. He was no longer just a banker, he was a central figure in the financial ecosystem, a man whose decisions could sway markets and industries alike. The true test of JPMorgan's power came in 1907. The Panic of 1907 began with a collapse in the trust companies of New York. Speculation and over-leveraging had left the system fragile. Depositors rushed to withdraw funds. Banks teetered on the edge of insolvency. The stock market plummeted. Fear spread across the country. There was no Federal Reserve to stabilize the system. No government mechanism existed to prevent nationwide collapse. And in that moment, Wall Street turned to JPMorgan. He convened the nation's leading bankers in his office. They were locked in a room, discussing how to prevent disaster. Morgan orchestrated the rescue of failing banks and trust companies by directing private capital and coordinating syndicates. His actions stopped a potential financial collapse. Morgan's control was clear. When he spoke, bankers listened. When he acted, markets stabilized. The crisis of 1907 also demonstrated the limits of government power at the time. Morgan's authority was unique. He had no official position in government. He had no elected mandate. Yet, in practice, he controlled the response to a national financial emergency. Following the panic, Morgan continued to consolidate industries. In 1901, he completed the formation of U.S. Steel, merging Carnegie Steel with other companies into the first billion-dollar corporation. He extended his influence into shipping, electricity, and manufacturing, building an empire of finance that touched nearly every aspect of the American economy. By the end of his career, JPMorgan had become synonymous with financial power itself. He had transformed Wall Street into a system where one man's judgment could stabilize or disrupt the entire nation. His legacy was undeniable. A combination of strategic consolidation, decisive action in crises, and unyielding authority had made him the man who controlled American finance. By the time John Pierpont Morgan passed away in 1913, he had reshaped the financial landscape of the United States in ways few could comprehend. He was a man of immense influence whose reach extended far beyond the walls of his bank on Wall Street. Presidents sought his counsel. Bankers deferred to his judgment. Industrialists looked to him for guidance. And yet, to the public, he was a figure both revered and feared. Morgan's critics accused him of wielding power that no individual should ever hold. They said he could manipulate markets, sway industries, and bend corporations to his will. These accusations were not unfounded. The Pujo Committee hearings of 1912 revealed the true extent of his control. Through interlocking directorates, Morgan had placed trusted associates on the boards of multiple major companies. He held influence across railroads, steel, shipping, electricity, and banking. He controlled corporations not by law, but by the quiet authority of trust, credit, and reputation. During the hearings, witnesses described how one phone call from Morgan could calm a panic or redirect massive flows of capital. Yet, Morgan's power was not simply about domination. It was about stabilization. When the United States faced financial crises, he was the man to act decisively. During the Panic of 1907, when banks teetered on the brink of collapse and trust companies failed one by one, Morgan convened the nation's leading financiers in his office. They were locked in a room negotiating the rescue of the system. Morgan organized private funds, directed syndicates of banks, and coordinated loans to prevent the failure of institutions that could have triggered a nationwide financial catastrophe. It was a dramatic display of influence, but it was also an act that arguably saved the U.S. economy from disaster. His methods were precise and calculated. Morgan did not seek publicity. He did not make speeches. He rarely appeared in newspapers for his actions. Yet, his impact was undeniable. Entire industries depended on his decisions. Steel, railroads, shipping lines, and emerging electrical companies all moved in accordance with the direction of his capital. In 1901, he orchestrated the formation of U.S. Steel, merging Andrew Carnegie's holdings with other companies to create the world's first billion-dollar corporation. This was not simply a business transaction. It was a statement about the power of finance to shape industry. Through these mergers, Morgan demonstrated how banking could become the backbone of the economy. He stabilized companies, prevented destructive competition, and ensured that industrial growth could continue without systemic collapse. But the concentration of so much power in the hands of a single man also revealed a flaw in the American financial system. There was no central bank, no regulatory authority capable of preventing or responding to panics. Morgan's control during the 1907 crisis highlighted the risks of leaving the nation's financial stability in private hands. And it was precisely this lesson that led to one of his lasting legacies, the creation of the Federal Reserve System in 1913. The Federal Reserve was designed to provide stability, regulate the flow of credit, and prevent panics that had previously required the intervention of a single private banker. In effect, it was a response to Morgan's unparalleled influence. Yet even with the Federal Reserve in place, the blueprint Morgan had created endured. The structure of Wall Street, the methods of corporate consolidation, the coordination of private capital during crises, all were inspired by the model he had perfected. His firm, JPMorgan & Co., continued to shape American finance long after his death. New generations of bankers and industrialists studied his approach, his ability to combine negotiation, credit, and influence into a system that could direct entire markets. Morgan's influence extended even further than finance. Through his consolidation of steel, railroads, and electricity, he helped shape the physical and economic infrastructure of modern America. Communities depended on his rail lines, factories depended on the stability he provided, and even international investors watched his actions to understand the health of the American economy. He was, in many ways, the architect of the industrial age in the United States. And yet, Morgan remained a private man. He shunned public acclaim. He rarely appeared in society for the sake of attention. His wealth, his influence, and his power were all wielded quietly, measuredly, and with precision. By the time of his death, Morgan had achieved something few could ever claim. He had transformed Wall Street from a chaotic, fragmented network of banks and corporations into an organized system where finance could direct industry, stabilize crises, and shape national policy. He had created a financial empire that touched every major sector of the economy.
Finance Story, the real story.